Fantastic. You made it to part 2 of the small business valuation, where we're going to be talking about SDE, figuring out exactly what the return is on your business so that we can apply it to a multiple. So let's dive in. Welcome back to part 2 of our small business valuation series. I'm Scott Duke. This is the Happy Dealmaker channel. We're all about empowering entrepreneurs here to build their companies so that they're sellable, so that when the time comes when you want to exit from your business, it's as easy as just tossing her up on the market. Part of that is knowing what the value is of your company to get things started, and that's what this little mini series is all about. And today we're diving into sellers' discretionary earnings, because that's where we left off from video 1. So if you haven't checked out video 1, then make sure to rewind, go back to video 1, and it'll get you caught up to speed with where we are right now. So as a quick reminder, SDE, seller discretionary earnings, times your multiple is going to give you the value of your company. And this builds on the bedrock of business valuation, which is risk and return. So how does this kind of tie back? Well, the risk is, as we talked about in video 1, is the multiple. The multiple represents the risk in your business. And then the return, of course, represents the benefit that the buyer is going to get or that you're currently enjoying right now. So with those two pieces, we can figure out the value of your company. Again, return equals SDE. So seller's discretionary earnings. What the heck does this word actually mean anyway? Let me pull up my little pointer here because it makes it, there we go. Okay, so sellers, this is easy. This is you, this is me, this is anyone owning the business, the one that's getting the current benefits. So that's us. Discretionary is I can do anything with it. It's not earmarked for any particular purpose. It's the cash at the end of the day that flows out of the company that is free and unencumbered. That's what discretionary means. And then earnings is the earnings that the company is generating, right? So seller, us, discretionary, the earnings that we can do anything we want with at the end of the day. It's kind of after-tax earnings. And earnings are earnings, right? Well, a pretty easy definition, but how do we actually calculate it? Well, inside that SDE, there's 3 main things. There's the income that the company is generating. There's the salary that you're paying yourself. That's definitely a benefit. And then there are the benefits, which is broken into non-cash expenses, long-term debt expenses, and the perks, right? So what the heck are those things? Well, we're actually going to go through a quick example, and by the end of this example, you'll know exactly how to calculate the SDE in your company using one thing, and that's your profit and loss statement. All right, so let's pull up a P&L, and we'll kind of go through this. And this is a P&L of a furniture retail store. So we'll walk through this kind of line by line and have a little discussion about how we're going to create SDE off of this income statement. I'll bring up my other screen. This is going to make me a little bit smaller, but this is going to give us a place to actually put the information that we pull. All right, so first out off of the gate, the easiest one for us to get, oh, why my pointer keeps disappearing. The easiest one to get is our income, right? Pull out your P&L, right to, close to the bottom, and you'll see income. All right, not net income. This isn't after taxes. We're using income. So if we cruise over in this example, it's $223,206, right? So we're going to move that over here. 223 and 206. All right, so that one's easy enough. Now the next one is also really easy. So we're just going to search through our P&L to figure out where our salary is, right? And in this, it's under management remuneration, and it's $55,000. You can say, oh, Scott, I pay myself in dividends. That's fine. We're not trying to pull that out right now. That's all good. We're trying to pull out how much we pay ourselves in salary. So sometimes your salary will be encapsulated within salaries, wages, and subcontractors. So it'll be down here in this line. So it could potentially be in the $312,000, but I can guarantee that you guys know what you pay yourself in salary on an annual basis. So just take that number and toss it here, and that part's done, right? Okay, now comes the part that is a little bit more, it's not confusing because I'll describe it to you and walk you through it, but it's more difficult than just grabbing the two numbers off the P&L. We're trying to figure out what's the perks, what's the benefits to you specifically for owning this company. And in this case, every company is different, right? That's why valuation has a little bit of an art to it, right? So let's figure that out and walk through step by step. So the first one here, it says non-cash expenses, these non-cash expenses, right, that we're looking for. Well, what does that mean? Well, really, all that is on your P&L, you'll have amortization or depreciation line. So this is, and you will know this, you're depreciating the assets within your company, and you get to use that as an expense, okay, each year. But that's not actually cash that's going out of your company. You're not having to write a check for depreciation or amortization. So this isn't cash that's actually going out. It's a perk. It's a benefit that you get because you get to use it as a write-off. But at the end of the day, really, this is cash that you could consider a discretionary cash that you can use in whatever way you actually want. So that's what this line is here, amortization. We're going to pull that number right there, 11,458. 11,458, because that's a benefit that we get in our organization, and it's actually cash that we can put into our pocket at the end of the day that does not show up in the income. All right, so this long-term debt expense, this next one, this is a little bit confusing. And if I'm not clear enough on this and you want to put questions below, feel free to do it. But I'll do the best job of describing this as I can. So when you're valuing a company, you're looking at it from the perspective of a buyer. Okay. At the end of the day, that's what we talked about in video 1, where we have our buyer there who's kind of representing the market, and we're trying to determine if we took this company to market, what would it most likely sell for? All right. So with that kind of hat on, thinking from a buyer's perspective, we look at the long-term debt on our business, what it's paying every year to service the long-term debt. So the long-term debt as it shows up on the income statement. And so we look at this, and here it is here, interest on long-term debt, it's $8,000, okay? So this is money that it actually is an expense that's going out of the business on an annual basis. So it's not discretionary earnings, it's not cash we're putting into our pocket. So why are we considering it a benefit? Well, we have to factor in when someone purchases the company, they may buy it with all cash and they may not have any debt to service. We don't know how they're going to structure the purchase of your business. So we can't assume maybe the debt that they take on is going to be more expensive. But again, maybe it will be zero, right? So what we're trying to figure out is if there was no debt on this company at all, if it was running completely debt-free, then this expense wouldn't exist, this $8,000. So we want to make sure that that's factored into our valuation because potentially the buyer won't have that as an expense, right? So that's the best way that I can describe dealing with this long-term debt and why it goes back into the calculation for SDE. So we're going to toss that $8,000 on there because if the company had a different debt structure, that may be cash that is available as discretionary cash to the buyer at the end of the day because we have our buyer's hat on. Okay, and then the last one here is perks, right? And what we're trying to figure out is, especially with small business, and again, this valuation calculating SDE is specifically for small businesses, that are doing underneath that $5 million a year in sales, that the owners are in the business on a daily basis. There's going to be perks that the owner gets, right? You yourself, you get perks from owning your business. You may have, a vehicle that's paid for. Like I stated in the other video, if you own a restaurant, maybe the restaurant's paying for some of your home groceries. If you own a construction company, all the renovations that are happening at your house, some of them may be running through the company, right? Like these are realities and these are perks to you as the owner, but they're showing up as expenses on the business, and they're expenses that the business doesn't actually need to incur to operate. So what we're trying to figure out here is, okay, if we didn't run all these unnecessary expenses through our business to reduce our income at the end of the day and reduce the tax burden that we have, what would the discretionary earnings actually be, right? We're trying to do that kind of audit on the company that if it was run, completely clean, what would it look like from an income basis at the end of the day? So let's do that for this company. And for this company, we'll walk through the P&L. And you can kind of do this for your P&L when you do this for your company, and you'll get an understanding of what I'm talking about as we walk through it. Okay, so if we go through our expenses, administration, there's no extraordinary expenses in there. Advertising and promotion. All right, so there's $42,000 of advertising and promotion in this company, but let's assume, let's assume for this example, this owner is running through some expenses through the advertising line item that aren't really necessary for the business. They could be, tickets for like leaf tickets, so that are, advertising because they need to network and market with people at these events. Well, really, that's not necessarily the case. So that box seat that you have at the sporting event, you don't necessarily need that to operate the business, right? So we're gonna put for perks here, there's some advertising. There was extra expenses in advertising that didn't need to be there of $10,000 for our box seats to the Leaf game, okay? Then the next one in this company, you're gonna go through line by line and make sure that, okay, are there extra expenses in here that don't actually need to be incurred to operate the business? And in this one, our example, the next one we're gonna use is, what I have written here for a little example, supplies. Okay, supplies. Supplies is a common one where people are putting stuff into. They're using supplies for their home that are going through their business and they're charging it through the business. So let's say that this business has, in the supplies, it's running $5,000 of personal expenses through the company for supplies. All right. And then lastly, oftentimes when we do valuations, there's vehicle expenses that are running through that aren't necessarily on company vehicles, right? These are personal vehicles. Maybe you're paying for oil. The company's paying for oil changes. The company's paying for repairs and maintenance on a vehicle that's not in the company. Gas that is on a vehicle that's not doing company things. So oftentimes extra expenses end up in a vehicle column that aren't necessary to run the business. So in our vehicle column, we are putting, of this 8,579, there's $4,000 worth of expenses going through there that are not necessary to operate this company. All right, so now we have all the pieces that we need, and we can kind of total this up. $316,664. All right. So that is the seller's discretionary earnings for this particular business. And you can do this for yours to figure out what your SDE is. And then you have your SDE component for your small business valuation. And in our next video, video 3, you're going to learn exactly where to get your multiple and how to calculate the multiple for your business. Then you'll have the two pieces you need to know it's not exact, but a very close approximation of what the value is of your company. And the last video, we're going to teach you how to increase the value of your company, right? And which is really simple when you look at it from a math perspective. It's, okay, I can either increase my SDE or I can increase my multiple. And we're going to teach you how to do both of those things. All right, kudos to you for making it through this entire video. It means you're dedicated to your business and increasing the value of it and making it sellable. If this video was of value to you, we welcome you to join the Happy Dealmaker community. Like, subscribe below. We release a video like this every single week to make your business that little bit better so it becomes that little bit more sellable. So when you go to sell, it's a piece of cake. All right, I look forward to seeing you in video 3.